Hello and welcome to the Super Investor of today. My name is Leonard Sczechowicz and I'll be taking you through the Super Investor Index with a little more added information for you today. Market efficiencies. Are those who beat the markets year after year just lucky? Since prices should always reflect all available information, or is there some other reasons behind it? Many professors who write textbooks today would say that yes. Looking for value with a significant margin of safety relative to price approach to security analysis is out of date. They believe in the efficient market hypothesis. Their hypothesis is that some market beaters are a result of chance rather than some sort of market adaptness. Warren Buffett challenges their luck. He asks, what if you were told in the investment world a disproportionate number of quote-unquote lucky investors came from the same intellectual organ? Let's take a look at least 20 years of investment performance of investors who came from the same school of thought and compare those with the S&P 500 and the Wilshire 5000. Warren Buffett goes on to say that these particular concentrations of investment winners come from a hypothetical village we like to call Graham and Doddsville. It is not a village per se, but rather an intellectual origin whose patriarch was a Columbia University professor named Benjamin Graham, along with David Dodd. Graham and Dodd set forth a theory of investment whose theme was to find a business with a price on the market that is lower than the value. Each of these students decided on their own manner of applying the theory. The record of success can't be explained by random chance. They simply act as businessmen who buy businesses through the medium of a marketable stock. The only thing that matters is the price and the value. Since the price is established by the market, the only work is coming up with the value of the business. Once this is accomplished, the investor needs to be patient for the market to offer a price that is less than the value of the business. Buying less than a company is worth the crucial underpinning to Graham and Dodd theory, since it provides them quote-unquote margin of safety. The flipping the coin experiment here. Benjamin Graham's disciples. Warren Buffett picked out a small group of successful investors who had beaten the return of the S&P year after year. He knew all of them, identified them as superior investors. However, he picked them out over 15 years prior to writing his essay. The small group of successful investors all have the same intellectual origin, Mr. Graham. Even though they all have the same patriarchal origin, they bought and sold different stocks and businesses. They have been following the same theory, a theory that has been set out forth by Benjamin Graham and David Dodd. Value investing. Value investing, Graham and Doddsville, investment theme is to find a business with a price on the market that is lower than the value, i.e. $1 for 40 cents. Time of the day of the month doesn't make any difference here. Beta, CAPM, covariance and returns, price, volume analysis does not matter. The only two things that matter are the price and the value, and since the price is determined by the market, let's just find out the value. The following examples are value investors. They all bought and sold different securities and companies. Some held a wide variety of stocks in their portfolios, while others only held a few variety, but all 9 follow the same Graham and Doddsville value investing theme. It's a big tent, as quoted by Jean-Marie Eliade. To me, value investing is a big tent that accommodates many different people. At one end of the tent there is Ben Graham, and on the other side of the tent there is Warren Buffett, who worked with Graham and then went out on his own and made adjustments to the teachings of Benjamin Graham. Value investing. Look where others aren't looking. Entertain, estimate intrinsic value. Invest only when there is a significant margin of safety. Variant view of future cash flows. The behavioral edge, as we'll talk about a little more. Be a contrarian. Invest in ideas that make others cringe. And always be patient. The 3 investment edges: analytical, behavioral, informational. But be careful. 2 edges too many will lead us to the analytical edge, the informational edge. Contrarian, a person who opposes or rejects popular opinion, especially in stock market dealing. The value investor versus the value pretender. And my favorite quote, be fearful when others are greedy and greedy when others are fearful. Why so hard, you might ask? As far back as early 1970s, Tweedy Brown partner Ed Anderson described the herd mentality of professional money managers. If a manager held IBM and it went down, it did not matter because everyone else owned IBM. Is today's IBM Cisco Systems? If one owned a more obscure company with a recently poor track record that got into greater financial difficulty, there was a considerable greater risk of criticism and losing accounts. The concept that investment risk is less a function of the individual company than the price of its stock is not recognized by many investors. Driven by emotion. The two most powerful and most troublesome emotions are fear and greed. All that matters is the price you pay and the value you get, and to exploit any major discrepancies when you find them. This style is known as value investing. Value investing focuses on financial performance such as the PE ratio, the price to sales ratio, the price to book value, and the dividend yield, as opposed to growth investing, which focuses more on earnings, the growth rate, sales growth, return on equity, and no dividend yield. Looking for companies that are going to grow earnings and grow sales, not an undervalued business as opposed to value. Buffett also talked about how risk and reward are not positively correlated with value investing. The less you pay for a business, you reduce your downside risk and therefore increase your reward potential, right? Why is it not followed by the masses? Buffett thinks that there are some perverse human characteristics that likes to make easy things difficult. Buffett also goes on to say that value investing doesn't seem to be a matter of IQ or academic training. It's instant recognition or it's nothing. Now let's look at the stunning 20-year investment performance of a few of those quote-unquote super investors who participated in these models. Warren Buffett atop the list. Ackery, Cummins, Simpsons, Hawkins, the list goes on. And let me tell you, they do outperform the S&P. 10-year rolling, you can see, against the S&P, always excess at least 50%. The 5-year rolling, always at least 19% excess return. And even when the S&P had the negative years, it looks like the super investors, nothing. My first addition to the SI list would be John Keeley of Keeley Fund Management. His investment philosophy seeks capital appreciation through long-term value investing in small-cap stocks. He emphasizes the purchase of companies undergoing corporate redevelopment, such as a spin-off, companies emerging from bankruptcy, securities trading below actual or perceived book value, savings and loan, and insurance conversion. Also, distressed utilities. As you can see, every year in excess, he did not beat the S&P. However, on the aggregate, if you look at the 15-year cumulative, 9 a year as opposed to the S&P at 4.5 a year. Another addition to the list was Charles Brandes. Charles Brandes is a Benjamin Graham disciple. Brandes consistently applies value investing to all his portfolio managed by his partnership. He seeks to purchase out of favor securities that are trading at discounts to their intrinsic value and then hold them until the market realizes their true worth. Managing $7.9 billion. And unlike Keeley, Brandes on the aggregate outperforms, however, if you look at 10-year cumulative, 3.1 a year as opposed to 7.2 per year. He has made a few mistakes. So my 8 super investors were Buffett, Ackery, Cummins, Temper, Hawkins, and Gabelli, and I also added my 2 to make the 8 super investors. If you look at the 5 and the 10, 15, and 20-year average returns, well over the 12 of the market. The 10-year rolling for my 8 super investors coming in at least 9.3, on average around 15 to 18%. And graphed, the blue line, which for the most part would be the highest return, would be the SI annualized average income. In 1995 it looks like, the S&P did outperform, however every year after that. The 10-year rolling, between I'd say 13 and 18%, well over the S&P, and the Russell 2000 coming in at the bottom of the list, underperforming the S&P and the super investor. The list goes on with the aforementioned investors. A couple more things that I would like to add would be how to calculate the intrinsic value, as we talked about. The market does establish a price, but the value can be found in the residual income process, the discounted cash flows. Another one will be dividend discount model. And a little more about the efficient market hypothesis, as talked about earlier. There's no luck here, as opposed to the super investor return, who states that have a sound game plan and stick to it. No speculation here. Put it on paper and follow the rules that you set forth for yourself. Another thing I'd like to talk about too is the modern portfolio theory, and it has to do with the risk-return trade-off. The more risky an investment, there's going to be a guaranteed return, since all available information is given to the market. It talks about diversification. Basically says that for a given rate of risk, there's going to be a given rate of return, and vice versa. If you want an estimated rate of return, there's going to be calculated risk, since all available information is given to the market and analysts. Going further with the modern portfolio theory is the efficient frontier. Bruce, Astor, Owens, the Super Investor Index. One can easily see from the graph that the Super Investor Index outperformed the S&P, the Wilshire, almost every period. The only period, 1995 through 1999, where it lagged, the market was during the dot-com madness, which is to be expected. Also, in the later years of the 2008 financial mortgage crisis. Overall, cumulative returns of the Super Investor Index were far superior than the index-based investment approach. Will these continue once everybody catches on? The answer is probably not. The reason is numerous, but most have to do with some institutional imperative discussed earlier. Besides, value investing is hard work, as bargains are hard to come by. History has proven that superior results will continue to be enjoyed by the practitioners of this art. Conclusion? The market is not 100% efficient. Even though all information is available at the time of stock purchase, there will always be wide discrepancies between the price and the value and how you perceive the value. MPT and EMH does not work. If equities are undervalued, should we rebalance to bonds as equities are going up? And value investing is quite simple. You find a business with a price on the market that is cheaper than the actual value. The only hard thing is calculating the value. Again, there are 3 ways, but it's very important to remember too that when comparing more than one company, you always use the same constants and the same approach. So what's the secret? Would you go invest with them, the super investors? Would you take your grandma's money and put it in there? Personally, I would. I mean, as you can see, the numbers don't lie. They do outperform. But I think the most important thing is to have a sound game plan, measure your risks, know what you want to get out of something before you get into it, and never change your game plan. My name was Leonard Sczechowicz. Thank you, and have a great day.